Now in chapter 17, we're going to be looking at sales mix and sales quantity variances. So we have two different um, materials. We have an industrial and a standard product. So we have our standard contribution margin per unit for each. We look at our sales mix. So our budgeted sales mix is 20% to 80%. We look at our actual results. We actually sold 23% to 77%. So then we look at what is our budgeted contribution margin at our actual quantities and what was our sales activity variance. So we break down those sales activity variances. We're looking at the master budget, so the standard contribution margin times our standard quantity versus the flexible budget, which is our standard contribution margin times our actual quantity. And in the middle, we have our standard contribution margin times the actual quantity. So in our flexible budget, we have their standard contribution margin is 7,000 and we sold 9,200. But in our master budget, our standard contribution margin is 7 and we had 10,000 budgeted. So our total activity variance is 5,600 unfavorable. Then we are looking at our quantity variance versus our mix variance. So what was the actual total quantity sold and what was the change just because our contribution margin changed because the percentage of our mix changed from the 80% to the 20%. So in the middle there, we're looking at our 20% and 80%. So what would we have looked at like if we had actually kept our projected sales mix? Then we can also have production mix and yield variances. So these are the variants that arise just because of a materials or a labor mix variance. So then our production yield is the difference between our expected output from a given level of inputs and the actual output we had. So what did we plan our output to be versus what was our actual output? So we have this example of a chemical company that makes Easy Foam. And Easy Foam consists of two chemicals. 60% of it is from C30 and 40% of it is D12. So we have our standard information there, our standard price per gallon, and at our standard cost per unit and the percentage of uses in the Easy Foam. What does that look like? So then we look at if we were going to produce 100,000 gallons of finished product, we would use materials and purchase were used. So our actual results are in the blue box. We have 100,000 gallons of finished product. We actually used 55 gallons of C30 and 49,000 gallons of D12 to make 104,000 gallons. So when we break that out for our 60 and 40 mix for our production mix, what we should have used is 62,400 gallons of C30 and 41,600 gallons of D12. So we break those in then to our yield and mix variances. So first, we're going to look at our efficiency variance, which gets broken down into our mix and yield variances. So we have our actual results and our on the left and our flexible production budget on the right. So for C30, when we look at the purchase price variance, we paid $5.20 times the actual quantity of 55,000 units gives us a price of $286,000. However, our standard price was $5,000, and at that 60% mixed, we should have used 60,000 gallons at a total price of 30,000 used. So we have a purchase price variance. Then let's get into our mix and yield variances. So we have the $5 times the 55,000. That's what we should have spent. So our standard price times the actual quantity. And then we have our mix variance because we should have used a 60% mix. So 60% of 104,000 should have been 62,400 units. Instead, we actually used 55,000. So we have a mix variance. We didn't keep to that 60-40%. So those build into our efficiency variance. Okay. So the yield variance, this is where we're looking at, it took 104,000 instead of 100,000 gallons to mix to produce 100,000 gallons of Easy Foam. Of those 100,000 gallons, we should have had 60,000 of C30 and 40,000 of C12. So we have already that we used 4,000 extra gallons to make 100,000 gallons of Easy Foam. So these result in our unfavorable yield variances, but we have a favorable mix variance for C30. We used less than we should have. We have an unfavorable efficiency variance for D12. We used a lot more than we should have, giving us a total variance in the production of our Easy Foam for purchase price variance of 38,000 favorable, but an efficiency variance of 110,000 unfavorable. We're going to do a couple of examples of this. So we can look at, these are the mixed variances and the yield variance shown a little bit cleaner than they are on the previous slide when we're looking at them vertically all together. So we had a decrease in what we should have used in C30, and we had an increase in the amount that we should have used of D12. When we journal those variances, we're going to put them into their own variance accounts, just like we would with the direct materials and the overhead variances, etc. So we would record our standard amounts into our work in process inventory, and we would record the variance amounts into their variance accounts. So it's very important if we're using a standard costing system that the only things that get applied to our actual inventory balances are those standard costs that we had calculated. We can also do variance analysis outside of manufacturing production. So we might use different things depending on what our business is. And there's some examples here of different kinds of activities that we might look at. We can also look at maybe how many hours it takes to clean a hotel room if we're looking at our labor for our housekeeping staff. In a hospital, we might also have number of beds in addition to patient days. There are a lot of different ways that we can break down these variances besides the direct materials and the production variances that we were looking at for a manufacturing company. So how do we decide which variances we calculate and which variances we investigate? So it really depends based on your company to company, what you decide is the most important. So maybe you're going to calculate all variances, but you're only going to investigate variances that exceed a certain amount. Some companies say that only unfavorable variances should be investigated. Well, that's not necessarily a great thing to go by because sometimes favorable variances have just as many issues as unfavorable variances. For example, if we saved $9,000 on the cost of direct materials, so we had this $9,000 favorable variance, but then we have unfavorable efficiency variance in direct materials, and we have unfavorable variances in direct labor. Well, maybe it's the fact that we bought such lower quality materials. That's the reason we saved so much money, but that meant we had a lot more waste. We had a lot more labor time applied to dealing with all of that scrap and waste, dealing with materials that would break, etc. So that means that $9,000 favorable variance wasn't a good thing, even though it looks like, yeah, we saved $9,000. That's great. So I don't agree with companies that only investigate unfavorable variances, but companies can make their own. Management by exception is an approach to management that requires that reports look at any deviation from a standard or a budget or an industry average. So this would mean that we're going to look at anything that is changed from our budget to our actual results. We're going to look at every single issue. That's what management by exception is. We should also look at who has control of that or the extent to which an item can actually be managed. Maybe we don't have any control in how the cost of our direct materials change from period to period. Or maybe the cost of our direct materials changed because we went to a different vendor. We had control of that. If it just went up 5 cents, we didn't have control of that. So really taking that into account when we're doing performance evaluation measures and we're trying to decide what happened that caused any variances to occur. And that is the end of chapter 17.